What's up investors, Snir is here. Today I want to address the most common response I get when I tell people I do active investing myself. Usually the response is a link to one of these articles. The Financial Times: active managers fail to beat the market again. 2/3 of US equity funds underperformed the benchmark over the last 12 months. Why active will continue to underperform? Most pros can't beat the market. Stock picking has a terrible track record and it's getting worse. Now, if that's true and professional money managers mostly fail to invest actively, who am I as an individual investor to beat them? Should we all just invest our money in index funds and be done with it? Well, not necessarily. These titles are manipulative at worst and not even wrong at best. You see, they are technically correct, which is the worst kind of correct, because they present a false image. In this video, I will cover why it's a false image, and by the end of this video, you will also know how the super rich fund investors hide their investing using derivatives. So stay on to watch that. Guys, before we begin, I want to mention that the content of this video and many other videos of mine is including in my site in a written form sent to my readers as a newsletter. So if you prefer reading or if you're a fan of newsletter, definitely check that out in the link down below. My site also includes tools and other content for individual investors, so if that's interesting for you, check it out. And one last task for me: if you can hit that like button below, as it helps me a lot with the YouTube algorithm and will be most appreciated. And with that said, let's go on with the video. First, let's examine where all these titles are coming from. Most of these titles are coming from one prominent research report that is called SPIVA, S&P versus Active. This report is a biannual report coming every year, and every time it comes out there is a PR campaign around it with more titles to fuel the fear-mongering against active investing. Moreover, the company behind the report, S&P Global, is the company that creates many market indices and profits from them. So there's an obvious marketing incentive for S&P Global that the report will present indices as the better solution for all investors, leading more investors to buy indices and thus making S&P Global more profitable. This is the equivalent of Coca-Cola funding a research that shows that sugar is actually good for you. That doesn't mean that the research is wrong, but you need to be more suspicious. And usually the research will use trickery to make variables tweak a little to get the results you want to present to the people. And I think that's what's happening here. If we look deeply into the variables and what they compare exactly, we will see there is less meaning in this research than the titles make it to be. So what does the research says? This research, and many like it, usually compare public funds to index funds, and they do it by categories. So if you have a public fund that mostly invests in small cap, it will be compared to an index fund of small cap companies. And this comparison consistently yields the result that the funds underperform their benchmark, their equivalent indices. But that doesn't mean that active investing by professional or active investing as a whole is less favorable to passive investing. And that all is hidden in the term public fund. What exactly does it mean and how we define public funds? You see, there are many types of funds, and public funds are just one type of them. Of course, there are private funds, and we will talk about them, but even within the public funds realm, there is much more smaller subsets that this research is focusing on. First, they focus only on mutual funds, which rule out any fund that isn't mutual fund. For example, ARK Invest is an ETF, a public ETF, but it is not a mutual fund and will be ruled out of this research. But even within the mutual public funds, they go even deeper. They go only to look at mutual equity public funds. That means that it rules out any mutual fund that invests in any other asset from equities. So if there is a mutual fund that invests in bonds or any other type of asset, it will be ruled out of this comparison. Now, when we talk about mutual public equity funds, it's very specific, and these kind of funds are structurally built to lose to the market. I know it sounds weird, and I will cover it in the next video, so if you watch it from the future, you will see a card above me now or a link in the description, or if you watch it in the present, hit subscribe to get this video. But structurally, I mean by regulations and by the incentives from their customers. And these kind of funds will lose regardless of other variables. In aggregate, I mean. Of course, there will be funds that will do better, but in aggregate, they will always lose because of the structure. So essentially, the research picked the type of funds that will always lose, and thus will always get the same result. Index funds are better, and it's good for the S&P Global company specifically because we want to sell you index funds, but that doesn't mean anything about active investing as a whole. If you want to see what active investing really can do, we need to see how active managers does without any strings attached. And the only place you don't have any strings attached in terms of regulations or incentive to the customers are private funds. Let's go deeper into that. Private funds, by their definition, are private. That's why we can't really access all the data about private funds, so we can't really say anything about them, good or bad, in aggregate, because we don't have the data. When we talk about private funds, we talk about hedge funds, family funds, and many other type of funds that are most prominent in the investing world today. Even though we can see some of those investors' actions through their 13F filings, those filings only reveal their investments in the American market and only when they outright buy shares. We don't see any options trading and we don't see any international activities. So keep that in mind. Even if you think you can see what these investors can do in the market, you can't really see it. Another issue is the derivatives issue. You might think that if these funds are big enough, we will see them as shareholders in companies in which they hold big enough shares to be presented to the public by the regulations. But that's not the case because most of these funds are buying shares using derivatives. Such is the story of Bill Huang of Archegos Capital, a story that never ceased to amaze me. Since 2012, Bill Huang of Archegos Capital turned $200 million to $20 billion. That's 1,000 times return on the money in 8 years. The only reason we know about him is because his fund blew out spectacularly. He got margin call on tens of billions of dollars in 2 days. But the reason we never heard about him before, and think about it, his fund held more than $20 billion, is because he held most of his shares through bank derivatives. So although he had massive holdings in many companies, his name and his fund name never appeared anywhere, only the bank's names, because the bank were the actual holder of the shares, and the bank only sold derivatives to Bill Huang. Now, if Archegos Capital wouldn't have blew out, we would never have heard about Bill Huang. Now consider how many private funds like Archegos Capital are out there that didn't blow out and will never blow out and you will never hear about. All of that is to say, we can't know how good the private market performs. We can't know how good private investors and all this world of active investing really performs because it's hidden. The only thing we can measure is the metadata. And the metadata tells me that most wealthy families and most rich people invest their money using private funds. And either they are all stupid and miss out on massive gains using just passive index funds, or it actually works out for them. I will let you decide. So to conclude, public mutual equity funds specifically underperform the index funds consistently. But that doesn't mean anything about active investing as a whole. Private funds have better conditions to invest in and actually represent active investing, but we can't know how good or bad they do because they are private. So that means that the individual investor might do well active investing if he does that intelligently and with practice and good practices. But that doesn't mean it's easy either. It's still hard, but it is possible. The titles that try to claim that active investing is playing against the odd is just plain wrong. You can do active investing and it might not be playing against the odd. It might actually playing with the odds if you do that intelligently. And with that said, we got to the end of this video. Don't forget to leave a like if you enjoyed this video and consider subscribing if you want to see more content for the individual investor. I'll see you in the next video. Bye bye.